Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's videos, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the four things we learned in the markets this week, starting with point number one. Point number one is 53% of the days are positive and 47% of the days are negative. That's in relation to the stock market. Why do I start out with that phrase? Well, the point of half the days in the market being negative and half being positive, yet the market is still positive 80% of the time annually, January to December, is that many days just don't matter. They just don't matter. So if you get frustrated, if you get nervous, if you get anxious when looking at your stocks, your portfolio, your investments, you shouldn't look very often because many of the days just don't matter. This week, we capped off the best week since November of last year and the best week of 2023 so far for the stock market. November historically is the second best month of any given year. So no surprise that the first 3 days, Wednesday, Thursday, and Friday of this week, were in the green pretty nicely. What catapulted the markets higher this week? Well, it's received finally what it's been waiting for. Proof that the Federal Reserve's interest rate barrage is having its intended effect on slowing the economy, namely the labor market that's been red hot. Well, we'll discuss the labor market in point number two, but let's dive into the weekly numbers we review first to see how they're looking in regards to how they affected the stock market this week. First, each week we do a gauge of if our economy is growing in the current quarter that we're currently in, and we look at the Atlanta Fed's GDP Now model to make that determination. And this week, the GDP Now model from the Atlanta Fed came in at 1.2% growth for the fourth quarter. That was actually down from 2.3% growth last week. Now remember, this takes data as it comes in and it puts it into their algorithm to determine where we're at from an economic growth perspective. This week's data included the construction spending release from the U.S. Census Bureau, some ISM manufacturing data. All that took a dive down, and so no surprise that it's lower this week. The Atlanta Fed is in range now with what most economists think the economy will do in the fourth quarter, which is right around 1% of growth. Additionally, each week we look at the initial claims for unemployment insurance. When this spikes, it tells us that more people are being forced out of the workforce and unable to find new jobs because they're filing for unemployment claims for the first time. This week, the claims jumped up to 217,000 for the last week, but as noted on the screen, still well within this last year's range, which have been at historical lows. Quick check on the 30-year mortgage rates, and that'll show us that rates did stabilize this week. Maybe one of the other reasons why the markets had a pretty good week. After they continued to climb week after week after week after week, they're currently sitting at 7.76 on a 30-year mortgage. And finally, let's see how that best week of 2023 turned out. The S&P 500, which is our proxy for growth in income, but only when taken together, that was positive 5.58% this week. The Russell 2000, which is our proxy for smaller and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive 7.57. Yes, in 1 week, 7.57. No mistake there after having a very rough start to this year, unlike our growth and income friends. And finally, the MSCI EAFE, which tracks developed international stocks across the world, excluding the U.S., that was positive 5.8% for this last week. And just to give you some perspective, the run that we've had this week is nice, but it's not going to get you back to your 2023 highs, just not yet, at least. As you can see on your screen, August, September, and October were not very nice to the market, and thus you're coming out of a -8 on the S&P and MSCI and a -16 on the Russell 2000. And those numbers actually do include the first 2 days of this week, Monday and Tuesday, which were still in October, obviously, and were pretty good. So if you take those out of the weekly returns aren't as good. My point here is that if you typically don't win it all back very, very quick when you have pullbacks or a 10% dip. My 2022 article titled "Bear Markets Normal Not Fun" highlighted that the average time it takes to recover from a bear market, like 2022, is 1.7 years. So it's a process. Point number 2, what the markets, Federal Reserve, and economists finally wanted to see is actually happening. Signs that the historically fast, note I said fast, not high, we've had higher rates, but historically fast rate increases that the last year that the Federal Reserve has put us through is finally showing signs of doing what it should do. This week, the U.S. Labor Department released the unemployment rate, the amount of new jobs created, and the average hourly earnings. All of these numbers came in with signs of slowing results and thus giving the markets the mindset that the Fed could be done raising interest rates. As a matter of fact, the CME Group, their FedWatch tool, we've looked at this many, many times on this video series. They show us that last week, before all this happened, the thought was there was a 79% chance the Fed kept rates the same at their December meeting. So high, but not certain. Right now, at this point, the number is closer to 95.2 after we received all this data this week that the Fed's not going to move interest rates. Now it's certain. Fed's not going to move in December. Additionally, the market-based rates that are not directly controlled by the Fed, they saw a large drop this week. So those are like the 10-year Treasury. Fed doesn't control the 10-year Treasury. The market does. But that started the week at 4.88 and then dropped to 4.76 by the end of the week. We also saw rates on the short end of the curve drop this week, going from around 5.5 to 5.4. So sorry, your 3-month Treasury bonds are not as good anymore. Still good, 5.4. Now the labor numbers. Let's talk about them. The U.S. economy added 150,000 new jobs in the month of October. Nearly all the jobs came from just 3 sectors of our economy, which were healthcare, government, I never want to see the government being one of the leaders in jobs, but they were, and leisure and hospitality. Now, when hiring is concentrated to just a few sectors, that could be another sign that the economy is starting to slow. One thing that definitely took away from the labor market in October were the strikes across a few different industries, but of course the most notable one, probably the one you heard about the most, was the auto worker strike. That cost automakers about 33,000 jobs in the month of October, 33,000 jobs from the strikes. On the other hand, average hourly earnings, those rose 4.1% from a year earlier, and that was down from 4.3% a month ago for the yearly numbers. So wage gains employees are seeing is starting to slow. Another good sign for the overall economy, because you need wage gains to be commensurate with long-term inflation, not way up here. Wage gains have been slowing since topping out at 6% in March of 2022. And finally, the unemployment rate hit 3.9%, and that is significantly, or slightly, not significant, slightly above the 3.8% rate that the federal officials had estimated we would end the year at. So all this to say, as we get closer to the year end, the recession that many people and economists, not this video series, we never said that. We thought we were going to have a good year, economy-wise, looking at the numbers, but they thought we'd be at a recession by mid-year. Here we are. It's just starting to slow down. Point number 3, another catalyst for the markets last week was the Treasury Department's move to announce that they will be increasing their long-term debt auctions by less than expected. Why is this important? Well, the Treasury Department funds the government. They issue the debt through Treasury bonds, bills, notes, and they have consistently had to issue more and more debt because we're spending more than when I say we, the U.S. government, effectively is us, but they're our representatives. They are spending more than they're bringing in through tax receipts and other revenues, and therefore the Treasury has to fill that gap by issuing debt. That debt can be short-term or that debt can be long-term. Now, here's a breakdown of the 10-year Treasury debt issuance over the last 8 years. You're seeing it on your screen right now. The problem with issuing more and more debt on a longer-term basis when rates are higher is that your interest expense is going to continue to go up and up and up, and then you're going to be locked into that interest rate expense for a long time. If the anticipation is rates will drop in the near term, you should issue more short-term debt, because if I get a 10-year Treasury at 5% and then rates drop to 3%, guess what I'm not doing? I'm not selling that 5% 10-year Treasury debt. You're going to pay me that 5%, U.S. government. This week, the Treasury noted that they would issue long-term notes and bonds ranging from 10 years to 30 years, slightly less than originally anticipated, and the markets love that. Trust me, we never talk about this. I have never even looked into this, okay? But this moved the markets a little bit this week. So for this to be in the news, it was a big deal and a sign the Treasury Department is going to deviate from their historical norms to adjust to what the market might be indicating is the best approach from a rate perspective. That's some good news, common sense in government. And finally, point number 4. These are the stocks that received the most attention this last week. First, been talking about it for a long time. Apple reported their earnings this week. And we've been telling you in the last 2 video series, Apple's going to report this week. Well, they reported. The announcement was not great. In that, we learned that sales were slowing in China, even while they're increasing in other parts of the world that are growing really fast, like India. China, big customer for Apple, they're mirrored in a terrible economy right now, and Apple is seeing pressure from its rival Huawei Technologies. Now, Huawei was finally able to release a high-end phone to compete with the iPhone after being unable to create such a phone because of Western nation sanctions. So people are buying that phone and not buying the iPhone. Apple's stock now sits at a 10% decline from its all-time high, but it's still up on the year, still having a pretty good year, as you can see on your screen. Those of clients that are in Ohio, they're going to know the name Cedar Point, or the stock symbol Cedar Fair Entertainment, because that's the parent company of Cedar Point. Cedar Fair and Six Flags Entertainment this week announced a $2 billion deal to combine forces. They're going to become one entity. The new parent's name will be Six Flags, so we might be losing the Cedar Point name, and we will retain Cedar Point's ticker symbol on the stock market, which is FUN. Fun! One of the market's best and brightest startups over the last 10 years was WeWork, and WeWork is expected to file for bankruptcy soon. They are a co-working office space that has fallen victim to a declining office market and just terrible management and debt controls. Look for that stock and company to be back down to zero pretty soon. And finally, regional airline JetBlue missed third quarter estimates and provided weakening fourth quarter outlooks because demand for travel is there. There's a lot of that, but they're blaming air traffic control delays along with weather pattern delays. And that has disrupted many of their flights. And it's always fun to check on Tesla, my friends. They're one of the 2 auto manufacturers that will be even around in 10 years. Everybody else will be bankrupt, according to a top auto analyst. Tesla, and I won't tell you the other name, but Tesla is the first one. This week, their stock gained 6%, and that bested the S&P 500. So thanks so much for watching this week's video. If you enjoyed this video, would you do us a favor? You can do us a favor by doing 2 things. One, you can hit the like button, because when you watch this video and don't hit the like button, we get a sad face and Google says they're no good. You want to tell them that we provide content that is valuable and helpful to you. So hitting that like button after you watch it helps tell YouTube and Google to push our content to more people, as well as you can hit the subscribe button, and that allows our content to be pushed out to you first. And when I speak of content, guess what we're getting ready to do? Tomorrow, we will be hosting an economic webinar for about an hour with one of the economists at First Trust. Now, First Trust is one of the top 5 ETF companies in the country. Their economists, led by Chief Economist Brian Westbury, are phenomenal. They do a great job. We're going to have one of them on a call for an hour where we're going to walk through a biblical view of economics. Then we're going to talk about what happened in the economy this last year and what happened in the economy over the next, what we think being the main term, will happen over the next 12 months. You certainly won't want to miss it, and hitting subscribe to our YouTube video will help you get that content once it's released on YouTube as well too. So thanks so much. You can also go to the comments section to schedule a meeting with any of our financial coaches, and our financial coaches help you in baby steps 1, 2, or 3, get out of debt, stay out of debt, hold you accountable to that plan, so you can eventually get on to 4, 5, and 6, where you can meet with one of our financial planners to be able to build wealth, live, and give like no one else. Thanks so much. We'll look forward to seeing you next week.